The person who recommended you buy whole life insurance, your bank relationship manager, your LIC agent, your uncle's friend, earned between 15,000 and 25,000 rupees the day you signed that policy. The person who would have recommended term insurance, they would have earned about 500 rupees. This payout gap is why relationship managers focus on specific products while rarely volunteering the cheaper alternative. High commission products get the glossy brochures and active promotion, while the term plan brochures often stay out of sight. This video reveals the mechanics behind the sales pitch and what the numbers actually show. Understanding this financial incentive is the first step toward making an objective decision about your money. Term insurance is pure protection. Pay a small premium, get a large sum if you pass away, nothing if you survive. Whole life, sold as endowment plans, requires a higher premium. Part buys cover, part goes to savings, returning money at the end. Getting protection and a maturity payout at the end feels like a better deal. The life insurance industry markets products specifically to trigger this reaction. When this instinct meets mathematical reality, the illusion of value vanishes. IRDAI regulations allow agents to earn up to 35% commission on whole life plans in the first year. On a policy with a 1 lakh rupee premium, that is 35,000 rupees straight into the agent's pocket. Compare that to the 7% commission cap on term insurance. For a typical 10,000 rupee premium, the agent earns about 700 rupees. If you were the agent choosing which product to pitch to a customer, the financial choice is clear. This behavior is a result of incentive design. The system functions as it is built to function. In retail finance, the product most aggressively recommended is rarely the optimal choice for the buyer. A 1 crore rupee term plan for a healthy 25-year-old over a 30-year duration costs about 8,000 rupees per year. The equivalent whole life policy with that same 1 crore cover costs roughly 80,000 rupees per year. That is a difference of 72,000 rupees every year. Invest that 72,000 rupees difference in an index fund at 12% for 30 years, and you end up with 2.6 crore rupees. A whole life policy returns a maximum of 1.5 crore rupees. Both provide identical protection, but the index fund builds 1.1 crore rupees more wealth. The whole life return effectively yields 4 to 5%. Over 30 years, that often fails to keep pace with inflation. The advantage of buying term and investing the rest is a calculated outcome, not a theoretical suggestion. There is one scenario where buying whole life insurance is technically justified. This applies to the person who stops their investments or spends their liquid cash as soon as it accumulates. Because missing a premium has severe financial consequences, whole life acts as a forced savings mechanism. For these individuals, a 4% return is better than the 0% return of an empty savings account. However, relying on an insurance contract to manage habits is a flawed strategy that limits your financial growth in every other area. In this case, whole life is an expensive mechanism to solve a behavioral problem. Here is the 5-step rulebook for buying term insurance without being sold something you do not need. Rule 1. Buy direct online. Direct plans from the same insurer are 30 to 40% cheaper because there is 0 agent commission. Rule 2. Calculate your cover amount as 10 to 15 times your annual income. Rule 3. Cap the duration at age 60 to 65. You need protection during your earning years. After 60, your investments should be large enough that insurance is no longer necessary. Rule 4. Choose a provider with a claim settlement ratio above 95%. Rule 5. Buy it young. A 1 crore rupee plan at 25 costs 8,000 rupees per year. The same plan at 45 is 28,000 rupees. Every year you wait, you pay more for the same protection for the rest of your life. Time is the biggest cost factor, which makes immediate action the most logical financial choice. Life insurance is one of the few industries where the optimal product for you is the least profitable for the person selling it. That relationship is not an accident. It is a core part of the business model. Understanding this allows you to engage with banks and sales pitches with a clear perspective on the incentives involved. The framework is simple: term, online, young, high cover, and a low premium. Any deviation from this plan means you are funding a salesperson's retirement instead of your own. If this changed how you think about insurance, share it with a young professional starting their first job.
Subscribe for the next video, and I will see you then.